Welcome back to the Wall Street Podcast. Today we're doing a deep dive into some critical financial and economic insights. These come from the Wall Street Journal reports published on Thursday, August 28, 2025. Our goal, as always, is to quickly distill the most important market-moving developments for you. We'll look at AI's impact, Federal Reserve autonomy, and trade policies. So first up, artificial intelligence. It's clearly still a huge driver for tech giants. Nvidia reported record sales that's fueled by AI computing demand. HP also saw a boost from AI-enabled PCs. But the picture for employment seems, well, quite different.
It really is. What we're seeing is a sharp split in the job market. On one side, the entry-level market, it's in a slump. New college grad unemployment is sitting at 4.8%. But on the other side, there's this incredible gold rush for experienced machine learning and AI talent. Companies like Databricks, Scale AI, they're offering very substantial packages. We're even hearing about some people under 25 earning seven figures. And this feeds into that whole debate, will AI eat software, or is it more likely to just augment existing complex systems?
That's a really stark contrast. So, okay, beyond the headlines about sales and this job market split, how is AI truly reshaping market valuations and the tech employment scene? What's the deeper story?
Well, NVIDIA's sales surge shows this immediate, almost intense demand for the hardware. It signals a real shift in capital AI is becoming foundational. In the job market, the key insight is this restructuring. Huge demand, very high salaries for specialized AI roles. Think generative AI research scientists, maybe 2 years experience. They can command base salaries, $190,000 up to $260,000. Compare that to the slump for general entry-level jobs. It's night and day. And while, yes, OpenAI shows us glimpses of software on demand, experts argue that complex, mission-critical software, particularly in regulated fields like HR or finance, well, that requires something more. They talk about multi-agentic systems, basically, multiple AIs collaborating. Those systems are still pretty early stage, so it suggests augmentation, not outright replacement, at least for now.
Interesting. Now, shifting gears slightly, another area flagged by the journal involves, well, systemic risks around institutional independence. President Trump recently tried to remove Federal Reserve Governor Lisa Cook. The reasons cited were unproven allegations. This seems to reflect a wider pattern, perhaps, of trying to exert more control over federal agencies. That's potentially a big deal for financial stability.
It's absolutely critical. Actions like that are a direct assault on the Fed's independence, something established way back in 1951. And as Greg Ip points out in the journal, markets don't seem to be adequately pricing this risk in. Analysts like Peter Williams from 22V, they warn that a politicized Fed, especially combined with high tariffs and stimulative fiscal policy, that creates an environment that's, well, just right for above target inflation, higher and more volatile inflation than we've perhaps gotten used to. Markets historically aren't great at pricing in these kinds of structural shifts.
Right. So given this direct challenge to Fed independence, what are the market implications, especially thinking longer term about inflation and stability when you add in those other policy factors?
The attempt to remove a Fed governor is, frankly, unprecedented. It signals a strong push towards politicizing the central bank, and that really undermines its autonomy. This potential rupture in Fed independence, plus the highest tariffs since the Great Depression, plus fiscal stimulus, it creates a potent mix. It seems ripe for inflation to stay persistently above target. Asset markets, it appears, might be underestimating this structural change. That could mean more volatility down the road and maybe a higher baseline for inflation and interest rates, regardless of any near-term talk about rate cuts.
Okay, another structural shift mentioned is in global trade. Aggressive tariffs seem to be reshaping things quite actively. For instance, the U.S. imposed a 50% tariff on Indian goods. That includes a reciprocal tariff and penalties related to oil trade. We're talking billions in commerce affected.
Yes, and those tariffs are expected to hit India's labor-intensive sectors hard. Think apparel, jewelry, shrimp. Widespread job losses there are a real possibility. And domestically here in the U.S., we're already seeing the effects. J.M. Smucker is raising coffee prices, citing tariff costs. Williams-Sonoma is increasing prices on some furniture, facing a 28% incremental tariff rate in some cases. This pressure on supply chains is significant. It's even led firms like Flexport, working with BlackRock, to double their supply chain financing pool, up to $250 million now, just to help importers cope.
So it's not just about consumers paying more, though that's part of it. How are these tariff policies really forcing U.S. businesses to rethink their fundamental supply chain strategies?
Well, exactly. Higher prices are the immediate hit for consumers. But the deeper strategic shift is that U.S. companies have to reevaluate their global supply chains fundamentally. This means things like pushing harder for vendor concessions, maybe exploring friendshoring, sourcing from politically aligned countries, or even bringing production closer. It's about de-risking. We're also seeing, as mentioned, more need for financing solutions for importers caught in the middle. It really challenges the decades-old model of pure cost optimization on a global scale. The focus is shifting towards resilience, political factors playing a bigger role.
So summing up the impact for you, the listener,
Yeah.
you could face higher prices on everyday things, from coffee to furniture, as companies pass on these tariff costs. And the AI boom, it looks set to create very specialized, high-paying jobs, but it also means the broader workforce really needs to focus on upskilling to stay relevant.
Absolutely. And adding to that, the path ahead for inflation, for interest rates, for overall economic stability, it seems increasingly tied to this delicate, perhaps strained balance between Federal Reserve independence and political influence. That's a structural shift, and as we said, markets often struggle to price those correctly in advance.
This deep dive really underscores the complex forces interacting right now: market dynamics, policy shifts, technological change.
Indeed. Perhaps something to consider is how these structural shifts, these changes in the bedrock assumptions about Fed independence or global trade flows, might reshape your long-term investment strategies. And maybe think about what unexpected connections could emerge between these seemingly separate developments.